Ready to roll?
And there
Okay.
we go.
All right. Hi, everyone. Nice to see all of you. And you can see me now, but I'm gonna switch over to sharing my screen and let's get started. All right. So let's see. Here we go. All right. So this is a webinar that I put together. It's based on a workshop that I have put together for folks who are either raising money for their own business, entrepreneurs or business owners, or people who might be advising those folks in a financial advisory capacity. And these are kind of 5 things that I wish I'd known before I started raising money for my first business. I'm an entrepreneur, and I launched a business back in 2008. One thing I really wish I'd known back then is that the global financial crisis was coming, and maybe I would have changed the timing of my launch, but I didn't. And so I started my business anyways. And I was a neophyte to the world of raising capital, and I learned a lot of things along the way. Some of them learned the hard way. And so I'd like to share these things with all of you so that maybe you don't have to go through some of the pain that I did. So the very first thing for anyone who is starting to raise capital might seem a little counterintuitive, but you want to start thinking about, where do you want to end up with this business? Where do you see yourself in the long term, and what does long term even mean? And one thing to know about this step is that there's no right or wrong answer. It's really up to you. There's no one right path to getting a business to where you want it to be. And I put this little map graphic up here because last summer, my father-in-law, who lives in Owl's Head, Maine, came over to visit us in Vermont, as he often does. And he usually takes the highway most of the way, which is that long gray route that goes down through New Hampshire and back up to Vermont. And that last summer, he asked about looking at different ways. He had a friend who said, why don't you take the path, the more direct route back through the mountains? And so he asked me to help him map it out and then give him some advice on the best way to get home. And I thought it was pretty interesting when I pulled up this map, and it shows 2 different routes that are different only, in time, only by a minute. The direct route, 5 hours and 12 minutes, versus his usual route down by the highways, 5 hours and 13 minutes. So, basically either way could have gotten him there in the same amount of time. But it's just the difference was really in how he got there. And that's very similar to what we're thinking about as we're raising capital for a business, and how we raise money to help us get there. The path you choose might have has different consequences depending on how you go. Like with my father-in-law, he could have gone the highway. It's all on nice freeways, no stoplights. Conceivably they're better, well-maintained roads, but the fewer places to pull over and stop. It does take puts more miles on his car. And there's some drawbacks there versus taking the more direct route, which is more scenic, and has some more places to stop, cute little towns along the way. But who knows, you might hit some traffic or get stuck behind a big slow-moving truck. So, like I said, there's really no right answer to how you get there, but knowing what is ahead of you on the journey can help you map out your plan. And so, as we're thinking about where you want to end up, I kind of put it into 3 different categories here. You have your businesses that I say, they're built to grow fast. These are the ones that are some kind of disruptive technology, perhaps, that can grow pretty quickly. And maybe you sell it off in 3 to 5 years, and you move on to the next entrepreneurial venture you want to engage in. So that's an option. And knowing that that's where you want to be can help you make the right choices in terms of the financing to help you get there. And we have a lot of businesses that are what I call built to last. These are businesses that people are starting. It's maybe a passion that you've had for a long time. Maybe it builds on experiences that you've had in a career working for other businesses, and you're ready to go off on your own and try it in your own way. And you want to build this business that's going to stick around for 5, 10, 15, 20 years, who knows? And with you helping to grow it along the way, building a team, and then maybe in a longer time horizon, you're going to transition it to a worker-owned co-op, or you sell it to your kids, or to another like-minded business that's in the area. So it's a different time horizon and different goals with what you want to achieve with your business, and therefore you'll be looking at different, or you should look at different financing options to help you achieve that long-term goal. And maybe you're open to either one of those. You know, you're thinking you're building a business that's going to last for a long time, but the right deal comes along, you know, you wouldn't turn it down. So just being aware of this at the very beginning, maybe even before you've built your first widget, will help you know the financing path that'll be best for you to follow. So once you've got a good understanding of that, it will help you to know whether you are looking for patient capital or growth capital. And you know, patient capital is, it's the way we define it is, it's patient because the expectations of those who give it to you are more patient. That's where the patience comes in. There's not the expectation that you are going to you know, receive this money, build a business really quick, and sell it to the highest bidder, so that the people who give you the money, your investors, are getting a high payout in the shortest possible time. It's really meant for businesses that are in that built to last category and need the financing to help them over time. Typically, patient capital comes in smaller increments. You know, you probably wouldn't go out to raise $2 million of patient capital right off the bat. It depends on what your business is, but typically patient capital will come in smaller increments and more often over time, versus growth capital, where you really want this money to help fuel explosive growth. You know, I hear angel investors sometimes talk about throwing gas on a fire. Like, that's what they want their investment to be, throwing gasoline on a fire to really rev it up and get the growth going, so that it becomes attractive to an acquirer at some point in the near future. And so understanding which type of capital you want to fund your business based on your long-term plans, as well as even your short-term plans, is helpful to understand. Because then what we start to think about is how you're going to structure any kind of financing deal that comes your way. If you are, you know, once you get an idea of whether it's going to be long-term patient capital or short-term step on the gas money, it's helpful to know how you are going to structure a deal, because that what you're talking about there are the terms of the relationship between you and your investor or lending partner. That's really what it is. And the interesting thing about this, or possibly the confusing thing, is that you know, you might think, well, debt sounds like patient capital, equity sounds like growth capital. And kind of in a general sense, that tends to be true. But there might be times when debt is less patient than equity for a startup. For instance, debt is usually pretty hard for a startup or an early stage business to get, mostly because it doesn't have any track record. Those who want to make loans to a business, they want to see a proven ability to repay the loan. So it tends to be pretty tough for a startup business to get a loan, precisely because it doesn't have any proven cash flow or profitability to demonstrate that it'll be able to repay that loan. And even if you do have a little bit of that, Usually it means, yeah, usually you're required to put up some kind of a collateral, whether it's, it is often, a lien on your home. It can be other personal guarantees or other collateral. I have heard someone putting up a vintage motorcycle as collateral on a business loan. It just depends on what the lender is willing to take. And then the thing that makes it in some ways less patient is that a loan requires repayment pretty much right away. You take out a loan, you start paying it back the very next month. And this can take cash away from an early stage business that would otherwise be reinvested into the early growth of a business. And so that's why debt is not always the most patient of capital, but in some cases it can be. And I want to make one more point about that last bullet point there, one that's really important to understand and often overlooked by business owners who are taking on capital, and that is this notion of becoming over leveraged, or some people say, you're carrying too much debt on your balance sheet, as a way that they might describe it. The best way I can illustrate that is just to tell you a little story of a business that I was starting to work with when my partner Louisa Shibley and I were getting Milk Money, our equity crowdfunding platform up and running. We talked with a woman business owner who had been in business. By that time, she'd been in business probably about 10 years. She made all natural cookies and other baked goods. She was in Whole Foods across the country. She had sales of $2 million, had, I think, probably upwards of 20 employees, and had just gone through a kind of a nasty divorce. Her husband had been her business partner, and he had been kind of the face of the company and the sales rep, and he was now gone. So she needed some cash to help her hire a salesperson to continue the upward momentum of her business as she continued to grow it. But up to that point, most of the capital that they'd brought into the business had been in the form of debt. And so she had been counseled that, that's going to be really hard if not impossible, for her to get any more debt capital coming into the business. So she really needed to look at equity. And unfortunately, what happened is that, I think there were a number of factors that came into play, one of which being that really heavy debt load that she was carrying on her balance sheet, which meant, a lot of her cash every month was going to debt repayment, that even equity investors were reluctant to come into the business, because they saw a lopsided capital structure that was not appealing. And I think there were some other things that came into play there, but it's just, I give this to you as an illustration of what can happen if a business relies too much on debt for their capital. On the flip side, then you have equity. And I know a lot of entrepreneurs and business owners are not enthusiastic about equity because it means giving up ownership. And I'm going to talk a little bit more about that in a minute. It's a very real concern. That first bullet point kind of says it all. The more money that you bring in, especially if you're bringing it in from sophisticated investors like regular angel investors, and by regular I mean that they're consistent, they are active angel investors, and venture capital funds. These are sophisticated investors, and they have expectations beyond just the rate of return that they're going to be expecting on your investment. They have other expectations to go along with it, which again I'm going to talk about in a minute. The other big thing about equity is that the way, unlike a loan that gets repaid over time through principal and interest payments, for investors to get their return on equity, there must be some kind of a liquidity event, which typically takes the form of a business being sold to another business and cashing out the the investors of the business. It's not always, that's not the only liquidity event that could happen with equity, but that's the simplest form that a liquidity event can take with equity, and it's the one that we see most often. And unfortunately, what can happen if kind of the counterpoint to becoming over leveraged and having too much debt, if you take on too much equity, especially if you take on equity at the very early stage and give up too much ownership to investors too early on, over time, as you add more investment capital onto your capital table, what happens is that the founder's equity gets what's called crammed down. It means that your ownership is diluted down so far that, I've often seen where a business grows, brings on equity investors, is successfully sold, and equity investors walk away with a pretty big and happy payday for them, but the founder at that point had been diluted down so far that they walk away with almost nothing. So just some things to think about as you're considering these different forms of structuring your deal. And the good news is that they're not the only deal structures in town. So hold that thought and we'll get to it in a minute. Because now I want to talk a little bit about this concern with equity and the difference between ownership and control. This is a lesson that my financial advisor taught me pretty early on when I was first raising capital, and was so helpful for me to be able to think of it in these terms. Because as I was talking about bringing on equity investors, and we had to start talking about how much, the percent ownership that we were going to be giving them of the company. It's like, this is my baby. Why am all of a sudden I'm giving up, I felt like I was giving up my sweat equity to other investors. And he made a really good point to say, first of all, let's talk about giving up that ownership. If you held on to this company and didn't bring on any outside capital, you could probably grow it on your own. And let's say you grow it maybe to a $250,000 valued company, and you owned all of it. So that's $250,000 worth of value to you, the founder. But let's say you brought on some investment capital that allowed you to grow the company in a bigger way. And maybe you were able to grow it, 10 times the amount that you were able to grow just on your own, with your own efforts. And so you get your ownership then gets, sliced down to 15% of the company. It's like, 15% of a big company can often be more than 100% of a small company. And in fact, in the numbers that I used here, 15% of a $2.5 million company is like $375,000, I think. So thinking about, it's like, just think about it. You want to get to the point where you're bringing on investment capital, and even though you're getting a smaller slice of the pie, it's a much bigger pie. So that smaller slice is still worth more than what you would have if you just kept it as a really small pie. So I think that's a helpful way to think about getting more comfortable with giving up some ownership of your company. Now, with that being said, the flip side, or the kind of the other side of that coin, is control. And this is something that you want to be really aware of, that you don't give up while you can get comfortable giving up ownership. Maybe you don't want to get too comfortable with giving up too much control. And this is where we start thinking about the management and the governance of the business. So as you might be approaching a deal with some potential investors, before you sign any papers and any checks are exchanged, these are important things to be worked out, and should be worked out with the help of attorneys and financial advisors. And when I say attorneys and financial advisors, the ones that work for you. The investor for sure is going to have attorneys and financial advisors who work for them and will be working to get them the best possible deal they can. You need to have that kind of of guidance and confidence on your side to be able to negotiate, because this is a negotiable exercise. You are not beholden to accept the terms of investors the way they lay them out. This is meant to be a relationship that has equal rights on each side. So what I'm trying to tell you here are what are some of the things you can negotiate into deals. And so as you are talking with investors, more than likely, if you are talking to investors about an equity investment, you might be able to keep a business structured as an LLC, but more often than not, you're going to be structuring your business as a C corporation. And if you have a C corporation, you have to have a board of directors. That's just the way the rules work. So if you are to that point where you're bringing on equity investors, you might convert your company from an LLC into a C corp, and now all of a sudden you need a board of directors. Okay, so let's think about this then. As investors are offering to invest in your company, often they will ask for a seat on your board as a voting member. And it's a reasonable expectation, but it doesn't mean you have to give it to all of them. And so limiting the number of board seats or structuring your board such that investors have a certain number of seats, and then you have a seat on the board, and maybe you have the ability to appoint or at least nominate other seats on the board to be able to bring in people who are maybe somewhat impartial. They're not investors, they're not employees of the company, but they are impartial and can add some perspective to your board, so that it's not, what you don't want to end up with is a board full of investors and you, because they're going to make decisions that are in their best interest, not necessarily in your best interest, and not always in the company's best interest. And here I'll tell you a little story of how I learned this the hard way. When I first took on my first significant round of investment, I had to add 2 seats to my board. I had a board, prior to that I had a 3-member board. It was myself, and then one other early stage investor, and then an outside, someone who had been an advisor to me, and I asked him to be on as a board of director, or as a director on the board. Once I brought in this new investment capital, I had to add 2 more board members who were both from the investor class. So at my very first board meeting, with this big chunk of money now sitting in my bank account that I could finally use to deploy the plans that I'd been pitching to all of these investors for so long, and saying, getting them excited about investing in the business, because here were my growth plans. I was met in that first board meeting with resistance from my new board members to my plans, which really kind of blew me away. At the time I had 15 years of experience growing consumer product brands. I'd worked for big name companies. I worked for Procter & Gamble and Welch's and Seventh Generation. And I knew a lot about how to grow a consumer products brand. And I was stunned that these couple guys who mostly had technology background, no consumer product background, were now telling me what I could and could not spend my money on. I wanted to, I was all ready to develop new products, expand the product line, and take our expanded product line now from small independent retailers into mainstream chains like CVS, Kroger, Target. And my board basically said, no, you can't spend any of that money on product development. And they had the ability to do that because they had the number of seats and they had the votes. So learn from my experience that these are the kinds of things that you can have an influence over before you accept any kind of investment capital. Limiting the number of seats that you give out to investors, and also limiting some of their voting privileges. There's such a thing as an observing board member. So one thing that I've learned since that experience was including some investors, they could have observation rights on the board, but not voting privileges. And so that's a way to keep them involved, let them have visibility into what is going on with the company, but still be able to maintain some of the control. And you can also include in your offering documents ways to make sure that that the board can't all vote to kick you out of a job, or at least after within a certain period of time they can't do that. But thinking through these things before you ever ink a deal with an investor will hopefully help save you a lot of heartache in the long run. So the good news is that debt and equity are not the only games in town. There's an increasing use of what are called near equity deal structures. And the one that's probably the most common that many of you may have heard of before is called a convertible note. It's set up similar to a loan with some significant differences. Most notably, the first difference is that it gives you kind of a grace period before you have to start repaying that loan. Usually it's 3 years. So within the first 3 years of receiving the investment, you can put all of that capital towards building the business. You're not making any loan payments. Usually there aren't even any interest payments. Interest accrues on the loan, but it's not paid. And then at the end of 3 years, conceivably your business is established. It's growing. If it's not already profitable, it's moving towards profitability. And at that point, the note can be triggered to convert into, usually they convert into equity, which gives investors the upside potential of participating in the success of the company as it continues to grow, or it can just be repaid as a loan. So it just gives investor and entrepreneur a little bit of flexibility with how you structure the deal. Another structure that I really like are these royalty agreements, and these are often, not always, but often structured as what's called a revenue share agreement. And again, like a convertible note, it can be structured with this grace period, but instead of being defined by a certain period of time, usually royalty agreements are, the repayment is triggered once the company hits a certain milestone. Say, for instance, once a company has achieved 12 consecutive months of profitability, that's when the royalty payments would then kick in, because the company is deemed to be at a sufficient level of ability to repay the royalty agreement. So these royalty agreements we're starting to see used a lot more often. The tricky thing with, or the kind of the caveat, I should say, with royalty agreements is that because they're based on a company's ability to repay, they're really not great for early stage businesses, because just like loans, you want to be able to see some kind of track record of ability for repayment. So typically we're seeing royalty agreements being used for a somewhat later stage company, maybe 2 to 3 years in existence with some proven track record. Now, a new innovation that I've been working on with an attorney friend of mine, excuse me while I take a sip of water, is a convertible note that converts into a royalty agreement. And so in that way, it can be something that might be more appropriate for an early stage company, because it starts off as a convertible note with that grace period, and then converts into a royalty agreement. And then another deal structure that we're starting to see more of, especially for very early stage, maybe even pre-revenue companies, is this concept of a recoverable grant. more often than not, it's something that's coming from maybe from a charitable foundation that would be doing some what's called program-related investment, or PRI. You know, so they might be investing in a business that's directly aligned with the charitable foundation's mission. And so they might do what's called a recoverable grant, where it's not a complete grant. You know, grant usually is seen as kind of, it's not really free money, but it's not completely free, I should say. But, you know, there's no, on a grant, there's no expectation of repayment. With a recoverable grant, there is an expectation of repayment, but there's no legal recourse to it. It's really much less stringent, the repayment terms. Typically, like a royalty, they'll be tied to some kind of milestone achievement. You know, if the company achieves X number of dollars in sales, or distribution targets, or something like that, then or profitability, then it would trigger the grant repayment. But the few of these that I've seen, the repayment is not fully defined in the initial paperwork and offering documents. It's much more loosely defined. So I think I'm actually working with a nonprofit now in St. Louis that is probably going to be using the recoverable grant as they're creating an accelerator for very early stage pre-revenue businesses, to bring them into their accelerator program. They would receive recoverable grants to help them get the business up and running, off the ground. And we were working through today, we were doing some financial modeling with them, and the expectations of the repayment on these grants, we're estimating at 30 to 50% of the grants will be repaid, and we even think that might be high. But it's a way for early stage capital to be given, especially to entrepreneurs who are really struggling with traditional sources of capital. Maybe they have bad credit, they're in a difficult neighborhood, economically challenged or distressed region, and for whatever reason have difficulty getting traditional capital. Recoverable grants are a way to jumpstart entrepreneurism among that segment of the population. I'll stop there. Are there any questions at this point, or should I keep going? All right, I'll keep going. So, with all of this information, this is all designed to help you achieve what I call, the best capital alignment for your business. Once you get a good idea of where you want to go with your business, let's find the capital that will help you achieve that. And before I go there, I'll tell another story, and this is one that probably many of you know, of hopefully what we don't want to happen is what happened with Ben & Jerry's. They were founded, Ben & Jerry's started in the late 70s here in Burlington, Vermont. They started making ice cream out of an old gas station, believe it or not, and grew pretty quickly. And by the I think it was 1984, so mid 80s, they were growing so fast that they needed to move out of Burlington and into a kind of a state-of-the-art ice cream facility, which they had found a place and were ready to, found someone to build it for them in Waterbury, Vermont, which is about 30 minutes away from Burlington. But they needed the capital to be able to do that. So they discovered this little-known law at the time that allowed them to do what's called a direct public offering, or a DPO for short. And a DPO is similar to its more popular cousin, or more well-known cousin, the IPO, or initial public offering. An IPO happens when a company has grown, maybe has been privately financed for quite a while, and then it goes public. It's shares are sold on the New York Stock Exchange or NASDAQ or some other exchange, and it's open to anyone in the public. You buy your shares through a stock exchange, usually with the help of a stockbroker. That's an IPO, a direct public offering is sold directly to the public. So they had this great idea to hold a direct public offering, which they did, and they had a Vermont-only DPO. Their minimum share purchase amount was $126, and they raised over $750,000 to build their new facility. And then several years later, they took the company fully public through an IPO, which they then opened up their shares to anyone through I think it was on the NASDAQ at that point. What happened then over time, 15 years, they were a public company, growing, very mission focused, triple bottom line, all that good stuff. But then in the late 1990s, Unilever came knocking on their door and said, hey, we want to buy you, and here's an offer. And Ben and Jerry didn't necessarily want to sell their company, but by that time they were a public company. They had a board of directors. They had a lot of investors. And basically, the kind of the long and short of it was that their board of directors voted to sell to Unilever. And Ben and Jerry, even though they tried to cobble together enough private investment to buy the company back, were not able to do that. And the board was fully within its rights to vote to sell to Unilever, even though that was not necessarily what the founders wanted to do. So that's why I wanted to talk about so many of these different things that are important to know before you start raising capital, so that you don't find yourself in the same situation. If you have decided that patient capital is the right structure for you, you are building a business that's built to last, you want to be running it for the next 10 years, maybe longer, and the kind of growth that you foresee for your company is more organic and slow and steady. You need capital to build the infrastructure of your business. And so that means, hiring new people as the company grows, and maybe you need new equipment, or you need to build out your factory. That's where patient capital can be probably the best way to get there. And so the sources that are most open to this kind of capital are investment from people who know you and are aligned with what you're doing. Those tend to be your friends and family, your neighbors, or people from your community, using local crowdfunding techniques. Many of these sources are really well tailored to patient capital, as well as banks and other lenders, like community development. A CDFI is a community development financial institution, or a charitable loan fund, like Vermont Community Loan Fund, New Hampshire Community Loan Fund. There are a number of these community loan funds around the country that provide patient capital. And often these deals are structured either as loans, they could be equity, but more often now we're starting to see them structured in kind of these near equity arrangements. On the other hand, maybe you have a company that you've got something that's really exciting and new and innovative, and it makes sense for you to grow it to a certain point and then sell it to another business that can really then a bigger company can take it and build out the infrastructure to grow it to its highest potential. No judgment on that. There are a lot of businesses for which that is the best path. That's when you need that step on the gas money to help with that new product development, or to really build out the maybe you need to build out an online e-commerce strategy to get it up and going, or to really get things to move. That is when the angel community and venture capital, or even crowdfunding at the national level under regulation crowdfunding rules, that's when that kind of capital really meshes well with that type of business. And often those deals are structured as equity and sometimes as near equity. So understanding where you're going, how you want to get there, will help determine the types of capital that will get you there in the way that you want to. And at this point, I want to open it up to any questions.
Janice, did you see the one there from Stephen?
No. Okay, give examples of types of business that you've seen royalty agreements work and a bit more on how those deals have been structured. Okay, great. Yeah, so one of the earliest examples I've seen of a royalty agreement was with a dairy farm that an organic dairy farm. They were started as regular dairy farm, converted to organic dairy farm, and then in order to kind of build out their the likelihood of success for their business of they wanted to diversify beyond just being a dairy farm, decided to add on the operations for a creamery to take their dairy products and turn them into butter, milk, chocolate milk, all that kind of stuff. So that meant moving into a significantly different type of a business, but they already had their dairy farm there with the proven track record. And so setting up a royalty agreement for that deal was really a great solution for them, because it gave them the flexibility, even though the creamery was new and they needed some time to get it up and running so that they could, it gave them the chance to build that business up and hit some milestones before they had to start making their royalty payments. That was a great structure for that. I'm trying to think of another one. I did typically, like I said, royalty agreements tend to be best suited for those businesses that have been around for 2 to 3 years and they're looking for expansion capital. To like build on, and like with the creamery, building more of a facility or increasing their distribution. So they just need that little bit of a runway with before they need to repay their capital. So the royalty structure gave them that flexibility to get the capital in, build the business, and then hit some milestones and start repaying. Let's see. What's your advice about under-promising or over-promising to potential investors, especially if you're doing something more experimental? That's a really good question, Karen. Both are dangerous. I'm just going to say it. They're dangerous. Over-promising is more dangerous. A big part of building the relationship with investors is managing expectations, setting and then managing expectations. So overpromising is just fraught with peril. I'm trying to think of a good example. Here's an interesting example of an early stage business. I was working with, I was talking with a fairly early stage business that had, it was a bakery down in Massachusetts, and they were making these really specific types of bread and baked goods from, I think they were Lebanese, and had some great distribution in the northeast corner of Whole Foods, and were looking to expand. This couple, as a husband and wife team, one of them had an uncle who was willing to give them the capital they needed to get in, but he wanted half of the business. And so their dilemma was, he's going to give us some money. He wants 50% of the business. We could do that. And so what we've done is we've mocked up these financials that, that we believe could happen. It was, it was their best case scenario, not the most likely scenario, that they wanted to share with this uncle to justify a higher valuation so that his investment might actually, come in at, so that they could basically say, yes, we want to get this investment, but we're only going to give you 30% of the business because we believe these expectations, we believe this best case scenario of our business will make the business worth more. And I counseled them against that because, for a number of reasons, because, the best case scenario hardly ever happens. And entering into a relationship with an investor kind of under those false pretenses just sets you up for some pretty, can be some pretty tense moments thereon. Because another thing that you need to know is that, I'm actually going to do one of these, a seminar like this for investors in about a month and talk with them about kind of the flip side of this, is that a smart investor should earmark some of their potential investment and hold it back as follow-on capital. So say I have $100,000 that I want to invest in a business, maybe I only invest $50,000 first. And be very clear with them up front, I'm going to invest $50,000 now. And then if I see certain milestones hit, I'll invest another $50,000, or, if the company needs more growth capital, I'll have some more to go in there. Having that kind of conversation and knowing that investors are probably holding back some reserve to invest in you later makes it really important to just be really honest and open about what your expectations are of the company and to be able to manage that conversation. So let's see. Great question or a comment from Michael about benefit corporation statutes that would allow a company like Ben & Jerry's to avoid a hostile takeover. As a matter of fact, the benefit corporation, the statutes, the statutes that B Corp, that B Lab recommends that you build into your articles of incorporation came almost precisely from the experience of Ben & Jerry's. It was designed to help prevent Ben & Jerry's situations in the future. So thanks for bringing that up. Let's see, touch on the structure of non-dilutable equity for founders. Do we have another hour? Let's see. That's one, I know, I'm gonna be honest, I know enough about that to be a little dangerous. I think it's a conversation better had with an attorney on how to set that up. And well, actually, here we go. One way is to have several classes of common stock.
Yeah.
Yes.
We did that, Janice, that essentially that you could give full voting control to, say, a Class A common, and then your investors get Class B common. And so you can divide what the rights are between those classes, which is another way of dealing with the Ben & Jerry's type problem, et cetera. And there's even, corporations like, for example, Berkshire Hathaway, Ford, have the multiple classes of stock. Ford Corporation, even though the family only owns like about 8% of the corporation, they still control it. And so, the multiple classes of stock gives you lots of different flexibility of doing things like that.
Absolutely. One thing to note on that, in my experience, is that especially for early stage investors or early stage businesses, and when you're dealing with angels and venture capital, is that they rarely are satisfied with common stock. They will want preferred stock, which gives them some different rights. And that's a conversation for another day. I actually think, like, if we could do away with preferred stock and just stick with multiple classes of common stock, it would solve a lot of the problems. So I do like that solution, and I think it's something that we should work towards.
And by the way, the one that I had where we did that, in fact, that saved our butt in a in a lawsuit, giving, control that those investors weren't able to break. And we did have Class A, Class B, Class C, plus preferred, and we were able to maintain control over the corporation as a result of that.
Oh, that's great. Good. This is why you need lawyers, because they're the ones that help you set that up.
Yeah.
I see another question here from Casey, which I want to get to because it's great. Crowdfunding shows up as both patient and growth capital aligned financing. Yes. And so what are some of the strengths and risks of raising through the crowd, and for businesses, for what businesses is this a good fit? Whew, another really great question. And a meaty one. Not all crowdfunding is created equal. I'm going to be I'll talk specifically about equity crowdfunding, which I think you probably already knew that anyways, but the distinction there is, things like Kickstarter, Indiegogo, those are donation-based crowdfunding. So we're talking about equity crowdfunding where you are giving some kind of investment. Now, equity crowdfunding is somewhat of a misnomer. With Milk Money, we used royalty agreements, we use convertible notes, that kind of thing as the deal structures, depending on the needs of the company and the best interests of the company and their investors. So I think the kind of the pros and cons of crowdfunding, I think for local community-based companies, those that are really trying to set down some roots in a community and build a business, create some jobs, create some local economic benefit, local crowdfunding is a powerful tool and can be very patient capital, because you are engaging your neighbors, your fellow citizens, and helping to fund a business that is going to benefit them not only in the return they get from your investment, but also from benefits that permeate back out through the community of having a strong, viable, job-creating business right there in your town or community. So that's why I put it in the patient capital column, and that's where I think some of its greatest strengths is when you can really use the tools to engage. Just it's what Ben and Jerry's did at the very beginning. Having their Vermont only stock offering. And the name of their campaign, they called it "Get a Scoop of the Action," and it was a way for Vermonters to invest in their homegrown company. I think that's a beautiful example of how crowdfunding can be used for patient capital. Now, the explosive growth in crowdfunding and in crowdfunding platforms in the country on a national basis has really, my opinion, spurred what I call kind of the angel wannabes, maybe folks who don't meet the criteria of accredited investor, and accredited investor is roughly defined as individuals with a net worth of $1 million, not including your home, or $200,000 annual salary. So, estimates are like there's, around 5 to 7% of the American population meets that definition of accredited investor. But that's not to say there are a lot of other folks out there who have some significant wealth built up and would like to, start investing like an angel. And regulation crowdfunding, or Reg CF, has opened that up. And so there's a lot of folks out there who are using some of these platforms to try to find, the next Facebook, the next Uber, the next, whatever hot big thing might show up on some of these crowdfunding platforms. And so in that case, if your business, if you think your business is that explosive, it might be a great way to get some early stage growth capital through one of these crowdfunding platforms. And I'm talking about platforms like WeFunder, NextSeed. I'm kind of spacing on some of the other ones, but WeFunder is by far the biggest one. And so that's why I put crowdfunding, or specifically regulation crowdfunding, Reg CF crowdfunding, in the growth capital category. And then just to your last point, from Casey, do I see investor interest growing on the platforms? I'm actually seeing, I'm seeing it start to wane a bit. I wrote about this pretty extensively in a book that I have coming out in about a month or so, and looking at first the growth of small local state-based crowdfunding platforms that were able to come online before the national crowdfunding laws were put in place, and so they were able to get a jump start on it. And seeing the kind of the meteoric rise and then the plateau and eventual decline in investor interest. And my theory on this is that for those who are not angel wannabes, those who are not necessarily the ones who are excited to go out and find the next hot thing and willing to do the work, to do the due diligence, for those rest of folks who want to be investing in local businesses because they believe in them, they believe that it's good for their community, that it's good for their local economy, it's a lot of work. It's a lot of work to review the offering documents, which often can be upwards of 15, 20 pages, sometimes more, full of legalese, lots of charts and graphs, and understand the nature of the deal. And then to do this time and time again with a number of different investments. So, the jury's still out on crowdfunding, but I'm seeing some interest slow down just because I think it was a novelty at first, and then people started to realize that that doing this on a regular basis takes a lot of time and effort to maintain a portfolio of all of these different investments. Because not only do you have to do the due diligence, you have to track them all yourself. You don't get the nice statement from your mutual fund or from your investment advisor telling you how your portfolio is doing. You have to track all of these yourself. So this is where I see the opportunity for evolution in community capital and for further innovation. And that's why I'm excited to see the growth of community investment funds where people can pool their money together and invest in businesses together, so that it takes some of the due diligence burden off of individual shoulders. So we're right at 4 o'clock. I could talk about this stuff all day, as you can see, but thank you for great questions. And if I didn't get to any of them, I put my email address on the pitch deck, or the presentation deck, which Ken will send out to everyone along with the recording.
Janice, may I throw in something very quickly just here? Given all the work we've done with a lot of startups, that what we favor in the initial funding are convertible notes, and there's a couple of points to put on the table to people about that. One has to do with the idea that obviously the very first money coming in is the highest risk money an investor puts up. And there's some really good reasons why for them to put up a convertible note rather than an investment, in that if it goes south, they can write it off that year. Whereas if it's a investment, then they have to stretch out the write-off over multiple years. And we found that a lot of investors like that particular issue. The other is that every single note allows you to customize the convertibility, even though if it's a corporation and you have a class of stock, normally, okay, it costs me X dollars for X number of shares, but a convertible note can be tailored so it's like 3 times that rate for the first one and 2 times that rate for the second one, et cetera. So every convertible note is customizable. So you can give your very first investors in the highest return, and then progressively down, and then when you actually convert over, they're all getting the same class of stock, but they're getting a different amount based on that conversion.
Yeah, great point. And and I hadn't thought about the first point that you made about the write-off piece. Like, I hadn't even thought about that. So thank you for that
Sure.
And I'll also add from the entrepreneur standpoint and why it's particularly so well suited for early stage companies is that it puts off the need to set some kind of false evaluation or false valuation on your company when you don't have anything to base evaluation on,
Agreed.
which can really lead to dilution issues in the long run. So I am a big fan of convertible notes, and I'm very excited about the convertible notes that can convert into royalty for the right kind of business. I think that's an exciting innovation.
Thank you for a great webinar.
Yeah, thank you, Janice, and thank you everybody for joining us today. I mean, we could probably go on and on for hours. There's such interesting stuff, and there are so many opportunities for innovation, right? And it's exciting to think about where, in particular, community capital strategies will help remedy some of the challenges that entrepreneurs have found. And I look forward to working with many of you on some of those innovations in the months and years ahead. Of course, I hope you'll all stay abreast of our webinar schedule and join us for future webinars and let others know about them. It's important for us to get word out about all that's happening, and we want to get folks excited about becoming, investors in their communities. Great. I think you all have my email somewhere in all the information that went out. Never hesitate to reach out with questions. Happy to either respond directly or find answers for you from others in our network. So thanks again.
Yep. Quick shout out to Steve Filler. Nice to see you here.
Thanks, everyone. Thanks, Janice.
My pleasure.
Okay. Are we done? Yes?
Yes.
Okay. Okay.